Hi, I'm Greg Welborn with First Financial Consulting in Pasadena, California. In today's Bench Talk, we're going to talk about life insurance. I want to help you all understand how they're put together and what the difference between various policies are. So if this is your insurance policy, 30, 60, 90 pages, pretty dense legalese, but here's what's going on inside. You're paying a premium, and that premium is comprised essentially of, first of all, mortality costs. These are the costs you're going to die in any given year, next year, the year after, etc. After that, there are some operating expenses, and then of course the insurance company has to generate a bit of a profit. These three basic expenses equal the basic premium. Now, your mortality costs are not the same every year. The odds of you dying when you're 20 are much lower than the odds of you dying at 86 is about when the government tables say our life expectancy is. So if you're 20, okay, your mortality costs are pretty low. You get to be 50 or 60, they're higher. You get to be like 85 and a half. The odds that you might die the next year or the year after are very high. So mortality costs go up. Accordingly, your premium, if all you paid was the basic premium every year, would just climb, and nobody really wants to do that. Most people want to lock in a certain amount of premium and say, I know that I am paying that premium, I can budget for it, and I can do it. So life insurance companies came up with something called term insurance. It's a variation on this theme. You pick the term. In our example, we've got 3, 5, 10, and 15 years. And here's the deal. You say to the insurance company, I want to have a level premium for 5 years. And they say, all right, we'll go out 5 years. We'll raise the premium a little bit, make it level for 5 years. Notice that you're paying a little bit more than the cost in the early years. You're paying less in the later years. But over the full 5 years, the insurance company has the money they need, and you've got the assurance that you've got life insurance for your family. What happens at the end of 5 years? Policy doesn't disappear. You can keep it if you want, but at the end of 5 years, that premium now has to go up and join what those mortality costs are, and it starts escalating. Same thing on 10 years. If you said, I want 10 years budgeted amount, they'd raise it a little bit. You pay more in the beginning, less in the end than what your true costs are, and at the end of 10 years, if you want to keep it, that premium goes up even more and now follows on mortality costs, and the same thing for 15 years. Okay? Now, 95% of life insurance policies, of term life insurance policies, lapse at the end of these periods of time because people get to this point, they don't want to pay that difference, let alone it going up, and up, and up. That's why it's called term. It goes away at the end of 5, 10, or 15, but it's purely your choice. You could keep it, you're just paying more. Now, some people say, I might need the insurance for more than 5 years or 10 years or 15. I might need it to be permanent, otherwise known as whole life. And let me show you how that works. We're going to go back to our illustration of the insurance policy, all those pages of legal mumbo jumbo. But remember, we basically said you've got some costs, those equal the term premium. If you want it to be permanent, whole life, the insurance company is going to add some extra premium in there. This extra amount plus those basic costs equals the whole life premium. So what do they do with the whole life premium? Why does it last your whole life? Well, it's so high that it's going to continue on for as many years as you want. Here's our term illustration again. So here are those costs that we're trying to either meet every year or average over some period of time. Well, whole life's got all of this extra amount built in. And the insurance company, in a whole life policy, takes the extra amount, invests it. Those investments generate earnings. Those earnings build cash value. Cash value is like a savings account or an investment account inside the life insurance policy. You've got your death benefit, but you've also got this cash value. And just like in a savings account, that cash value itself also generates more earnings. At some point, the whole life premium can vanish. It disappears in the sense that you don't have to pay it out of your pocket anymore. Now, I want to be very clear. A life insurance policy has a premium due every single year, and it must be paid. The only question is, are you going to pay it out of your pocket, or are you going to pay it out of the cash value? And here's what's going on. At some point, as that cash value grows, remember I said it generates earnings itself? Well, let's say you've got $1,000 in cash value, and it's earning 6%. That's $60 in earnings. If your whole life premium was $50, you can take some of the $60 and you can pay the premium, and this is the vantage point. The point at which the earnings from the cash value are equal to or slightly larger than the whole life premium that is needed. So, should you get whole life or should you get term insurance? Basically, it depends on what your investment return inside the policy is going to be and what are your goals. If you have any questions about whether you need term or whole life, or if you've got a whole life policy and you want to know whether it's performing for you and you should keep it, we'd love to chat. Feel free to give us a call or drop us an email. Thanks for listening.